What's up, guys? Thank you for watching. It is Saturday, September the 21st. I hope you are having a pleasant weekend. And let's see, in preparation for what's to come in public markets and private markets, in the alternative investments and different types of asset classes, we're going to think philosophically and strategically, looking at different technical and fundamental indicators about where best to put capital to work. Okay, so leave your emotions and feelings at the door. It's time to put your cowboy hats on and be pragmatic. Before we do that, this is something new, a new format. This is client requested feedback, or some of the folks at home have asked, because I was able to predict that rates would come down. I was wrong. I said 25, they ended up doing 50, so I had to reposition and do some different mathematical modeling. Fine. But one thing I was right about is that the short end of the curve would come down, but the long end of the curve would come up. And this always happens in these different cycles. You might have a real estate agent telling you when the Fed cuts rates, that's when you can list your house, or that's when you can buy, or they give you the idea that the Federal Reserve controls the entire curve. Central banks can perform yield curve control, but they don't influence the entire curve. I'm going to show you how that works. That's one piece. Another one is about when you want to put capital to work, but you're nervous. What if it goes up? What if it goes down? Should I lump sum? Should I dollar cost average? I'm going to show you how to, like I just said, take feelings and emotion out of the equation and build a dollar cost averaging strategy using research that you can conduct at home. Okay? So those are going to be first things we do, those client requested things. Then we're going to be looking around. And like I said, feel free to skip around. And if not, just watch the whole dang thing. All right. Everyone says to be long bonds when the Federal Reserve starts cutting rates. They're deceiving you, I think would be fair to say, because there are different parts of the curve. There is immediate term expiration. The federal funds rate is the overnight financing rate. So literally, if I borrow today, what I got to pay on an annualized basis, and I'm going to give it back to you tomorrow. That's what they're controlling between borrowing rates for central banks. So this has a direct impact for borrowing rates for a month, a couple months, as long as 6 months, 12 months, up to a year, maybe even 2 years. But they're not going to necessarily have much direct impact if I'm borrowing for 3 or 5 or 7 years. And TLT, and everyone loves TLT, they say long bonds, the Fed is cutting rates. Well, these are 10, 15, 20, 30-year expirations. There's a lot more that you need to mathematically model and price in if you're going to be holding a piece of paper for 10 years as opposed to 10 days. So when would you have wanted to be long bonds? Well, I had drawn this pattern here. Let me give you a little bit more of a time frame, because TLT is a great example of a position trade. I mean, it's a bit of shape shifting, I'm not calling myself a technician here, but a little bit of a diamond bottom. It might look a little bit better on the weekly chart. Let's give myself some credit. Well, the breakout worked. Okay, let's just put it that way. We hit areas of confluence. Look at this hammer candle here. That hammer, and then it came up above the 8, the 14, and the 20. This is when you would have wanted to be long the bond. Markets are forward looking. So if you had gotten in about 2 months ago, you could have rode this up about 10, almost 15%. Or if you were in TMF, the triple leveraged bond holding, could have made some decent money there. But when the Fed actually cut rates on Wednesday is basically where we formed this local top. Okay, let's take a look here. So what we got, I think we tagged 102. Did we get to 102? What is that? 101.75, let's call it. And we have been going down. Now look at this reverse hammer, inverted hammer. Now we're below the 8, the 14, and the 20 on the daily. And this is not a great looking chart. It's hard to use technical patterns in trading something like TLT. So let's not get into that whole fiasco. But this is the point. The dollar is signaling some weakness. We can look at the DXY index, and the Federal Reserve is signaling that they're going to support growth. And if the growth trade is back on, and you start pricing in monetary currency debasement for the dollar, now the bond traders are pricing this in. If they're going to be holding a piece of paper for 10 or 20 or 30 years, fine, I'll take 4% if I'm borrowing for 3 months. Fine, I agree with you there, Mr. Fed. But if I'm borrowing this for 30 years, I want 5 or 6 or 7 or 8%. Because here's what they're pricing in. And this is just good old ChatGPT. Inflation expectations. If we think inflation is going to rise in the future, then I want higher yields if I'm going to hold this piece of paper for a longer amount of time. This goes back to the math. If I'm holding a bond or whatever, a piece of paper, an IOU, let's call it an obligation, for 3 months versus 3 decades, it's so much more time for uncertainty and events that are difficult to predict to play out. The dollar could crash. There could be inflation. There could be breathtaking amounts of monetary stimulus. You have to model that in. The growth and outlook. Growth trade seems to be back on the table. If there's going to be economic growth, then I'd rather participate in equity upside than holding a bond. So you need to compensate me for that. If I'm going to give you money that you're going to go grow your company with, if you're going to be growing at 10, 20% compound annual growth rate, I expect to get probably closer to 6, 7, or 8% on my bond yield. Supply and demand. This is an important structural dynamic because if I want a 5% return and I can get it in a 10-year bond, but you're only giving me 3 or 4% for a 10-month bond, then where do you think the demand is going to be in that part of the curve? Why would I want 3% when I could get 5% elsewhere? So that's just, standard supply and demand dynamics. Market sentiment, investor sentiment, risk appetite, standard behavioral stuff. We don't really have to comment on that. That's more philosophical. And then Fed policy communications. Communication is an interesting word. You could also call it propaganda. And I'm not saying that with a tinfoil hat. In fact, I'm saying it with a cowboy hat. But what you're trying to do as the Federal Reserve, as the central bank, is control the psychology of the market. If people are spending money, then the economy is going to be healthier. It's like a self-fulfilling thing. Whereas if people feel like recession is coming, it's a self-fulfilling prophecy because they'll stop spending money and then corporations have fewer revenues and then corporations start to lay off the people and it's a circular thing. So the way things are communicated, the market has to price that in. But long story short, going back to TLT here, you don't necessarily want to be long bonds. It's more like interest rate arbitrage at different areas of the yield curve based on what the Federal Reserve is raising or cutting. So I hope that is helpful. And going back to the real estate example, this is how the Federal Reserve can cut rates because what they're doing is cutting near-term expiration, immediate-term expiration. They're not cutting longer-term expiration, which a 15-year, 20-year, a 30-year mortgage is effectually a long bond, the way it's structured. That's how the Federal Reserve can bring rates down and borrowing rates to put a down payment on a house can go up at the same time. The other item I had a request from one of you guys about was dollar cost average investing versus lump sum investing. And specifically Bitcoin was mentioned because in general, this one is more volatile than other asset classes, which leads to more difficulty in predicting the price action. So fair enough. You want to dollar cost average instead of lump sum. Let's say Bitcoin is the instrument. So how would you make a plan? Let's say we have $100,000 to work with, and let's say we've got a 3 or 6 month time frame that we want to utilize. Let's look at data. It is September. How does Bitcoin perform? And these are items that you could pull up. I'm not saying don't work with a professional, but you can be proactive and find a lot of information like this and do your own proprietary research, just to be clear. September is one of the weakest months. So let's say you have money, you want to invest in Bitcoin, but let's not do it in September. And what's your basis for that? Well, let's see. The average in September, minus 4.78. So if we were looking down at the bottom here, it is actually the weakest month for Bitcoin. Okay, so that right there rules out lump sum investing because it's September right now. So, why the heck would I do that? Whereas October around 23%, November around 47%, December 5.5%, January 3%, February 15%, March 13%. Okay, so October through March, that looks like pretty good stuff. But still, with all the uncertainty in the world, I don't know what's going to happen with the political outcome. If it's Trump, we could go to the moon. If it's Kamala, I'm going to be having my unrealized cap gains, whatever it is, or God forbid, escalation of war or systemic collapse, which we're going to talk about that, by the way. We have to talk about appropriate hedging strategies for tail risk. I just reminded myself. That's important stuff. But okay, so let's just say we could lump sum invest in October. We could do that, but we still want to give ourselves some time. So what can we do? We have 100,000 bucks. Let's say we want to put about $5,000 to work 20 different times. So 20 divided by 4 gives us about a 5 month window. Okay, so that seems to make sense. But then how can I make this more efficient? I don't know when to do it. Now, let's get back on. Again, this is just literally, we're using ChatGPT. Like, this couldn't be easier to do. What day of the week is Bitcoin weakest? Bitcoin's price can be influenced by various factors, but Sundays, lower lower price action, lower volatility. It's also one of the only market classes that's open on the weekends. So if you have an immediate need for liquidity, Bitcoin's what you're probably going to sell. So that makes sense. So 20 Sundays in a row, we're going to put $5,000 to work in Bitcoin in our dollar cost averaging strategy. But when are we going to do it? We can get even more granular. What time of day? So typically between midnight and 8 a.m. Eastern Standard Time. Well, that makes sense because the Asian markets open about 15, 17 hours ahead of when we do here in the States. So you want to get a jump start by doing this probably early morning Sunday. Do it before you go to church. And there you go. It's as easy as that. So 5,000 bucks. Let's say we wake up at 6 a.m. or maybe you sleep in 7, 8, I don't know, 9 a.m. Sunday. You put your 5,000 to work. You do that 20 times. And another thing we should talk about is how you're going to put that Bitcoin into cold storage. Okay, you don't want to leave it on an exchange. That's a topic for another time about self-custody of your assets. But there you go. There's a dollar cost average strategy. We built it with our own proprietary research, looking at which months of the year it makes sense to do this, which day of the week, which time to do it. Done. Set an alarm, keep my liquidity available for that specific purpose, and there you go. Not that complicated, right? In general, that you can go back and look at the capital market outlook videos. I'll link them down below, where we've forecasted what we think will happen across a variety of private investments and alternative asset classes, and specifically how we think capital markets are going to respond both here in the US and internationally. We have a few preferred, or let's say favored countries or sectors that we particularly like. One of them I just did a quick investment theme about different parts of the energy production process. The energy, electrical, utility infrastructure space is just such a slam dunk with the data centers, electric vehicles, Bitcoin, cryptocurrency mining, you name it. Energy consumption is going to be up across the board. So not a ton of new information I want to convey here, but we have to refresh it on a weekly basis. So let's look here. This is from Merrill Lynch. Economic data inconsistent with impending recession. So they don't think there's going to be a recession. I think they have like a 90% chance that there won't be one, at least not immediately, which actually, if you're a contrarian, sometimes I have a bit of a contrarian streak that gives me a little bit of a pause, let's say. Election implications to consider for fixed income markets. Well, we've did some stuff about interest rate policy at the beginning of the video. So let's just say that's not exactly where we're looking. But there's a chart we'll get to. The insurance gap, I'll show you guys that one. Market update shutdown or just another Capitol Hill showdown. So, the politics. I don't love the politics. I'm looking forward to being done and dusted. I have a few preferred outcomes, but I'm not gonna get into that. But let's just hope that those guys do their job and not do it terribly. It's really all you can do from our perspective anyway. Because scared money don't make money. And now is a pretty decent time to be putting money to work as there are good deals. So it doesn't seem like there is going to be an impending recession. All right, fair enough. There's some data there. Well, let's get to the charts. We've talked about how we don't see a recession in the near term either. Okay, so growth near trend is inconsistent with much higher unemployment. Okay, so what you want to see is unemployment stagnate, or if it rolls over and starts to go back down, then growth is back on. And the growth rate has started to come back on in the days ending last week as the semis and tech started to perform well, and things like real estate, utilities, healthcare started to sell off. So risk came back on. And we had some good jobs data to substantiate that. Okay, so that's what they mean by inconsistent with recession. It's a good thing. Election impacts. So this is an interesting one about interest rate volatility from election peak. the change in interest rate volatility from election peak and 6 months later, and then the change in something like triple Bs. So looking at the interest rate volatility, it tends to decline. Credit spreads compress from peaks ahead of a U.S. presidential election. So we've seen that. They tend to come down, even in 2020, which was a strange one for a variety of reasons. So hopefully that trend will continue because predictability is what you want in a capital market when you're doing your modeling on Excel sheets. If you can have rates unchanged or at least not volatile, then it's easier to model and you can move ahead with more confidence. More confidence with rates coming down means more deals will get done. And we've looked at the quote unquote treasure chests full of cash, people ready to deploy capital. Steady, lads. What else? Protectionist trade policy, tax cuts and jobs. This is a big one. The corporate rate being brought down from 35% to 21%. And we're seeing this like, who was it? Was it Goldman Sachs put out a little bit of a simping report for one of the candidates? Now, they seem to think that if we were to extend the Tax Cut and Job Act, then between 2025 and 2034, the deficit would increase to $4.6 trillion. It's strange. It's strange how they come to the conclusion that taxes need to be higher and never that spending needs to be done better. But try not to get sucked in to the whole thing. Higher deficits, yeah. Higher deficits could lead to higher long-term treasury yields. We talked about that. More spending, more growth, yields on the long end need to go up. So you'll see an inversion of the yield curve, not necessarily because a recession is imminent, but as part of this dynamic specifically. Growth is back on, ahead of monetary stimulus, ahead of debasement of the dollar. Yeah, you got to compensate with a higher yield if I'm going to lend you money long term. Let's go to the insurance thing. We're going to end up spending too much time here. But speaking of things that are frustrating, uninsured losses are the majority compared to insured losses. Or maybe it's a little bit even on this left one. But I mean, what is the point of insurance if I'm not insured? This is an important one. I've dealt with clients where one of the things that I say, which sounds a little bit counterintuitive, is have you considered bringing your fixed costs down? And it's like feels like a meme. But point being, just because you pay a flat rate every month for your insurance doesn't mean we can't look for better coverages that actually are going to provide you better insurance and you're not going to have to pay as much money. Not too good to be true. It's just one of those things. You buy your insurance product and then years go by and you never think about it ever again, right? I mean, do you even remember the insurance consulting process? It's just one of these throwaway items like get it done, okay, now we're insured, fine, and you never think about it again. Worth reviewing with someone who's got your best interests in mind. And then the markets. Okay, so now let's just fly through some stuff. Private equity, this Motel 6 one. I'm probably gonna tweet about this because they talked about how Blackstone acquired this for like 1.2 billion back in the day, and now they're getting 525 million in this all cash deal. But Blackstone did some clever things, all legal, that they were able to generate a substantial amount of profit and revenue throughout the ownership life cycle. They make it seem like they bought it for 1.2, they sold it for 525, they only got 50 cents on the dollar. It's not exactly how that works. So be careful with the headline stuff. Axel Springer with KKR splitting up a publishing giant. Okay, that's good to see some traction in these spaces. Entertainment, publishing. There's a lot going on. So we want to see deals get done because the more deals get done, the sooner we can get to the other side of the rainbow. What else is going on? Nah, property investors went out. Bargain hunters rush in. Sure, that's going to keep things propped up in the real estate markets. What else going on? Financial Times. European Tech Investment Group, 600 million debut fund over there in European venture capital. You like to see that. Apollo pushes into high-grade debt business. Okay, so they're making some leeway. They used to call this in the Financial Times the turf war, when private equity and private credit was infringing on the rights of the banks. So now that they're getting involved, they're pushing into a business long dominated by banks. That's good. Jostling to sell alternative assets to wealthy investors. This is a good thing in terms of democratization of alternatives, but also it's becoming crowded. And, part of the selling point used to be that you were getting attractive valuations at early stages and you were one of the special ones that you had an in. It's not really like that anymore. So I think, through Darwinian evolution, some of this stuff needs to go away or people are just going to get burned and going to have to go back to the good ones. Apollo going after Wall Street's core. All right. Getting into sports, always a good diversifier. Plus, come on, who doesn't want to own a sports team? When private equity is the friendly choice, okay, going after Robert Murdoch's empire, interesting. Private credit stuff, private equity suitors line up for eye care auction. I've seen more deals get done in the alternative space in healthcare and in cosmetics. I think, it's never a bad thing. Grant Thornton, shortlist of bidders for a UK franchise. Good. I like Grant Thornton. I've done some tax work with those guys. Private equity is doing badly, however you measure it. Investors desperate to get cash back. So this is an important thing to think about. If you get into a fund that has a lockup provision, you better damn well know about their plans, and they better have a great track record of delivering shareholder value, because there's just better options at this point. So, however you measure it, well, I mean, it depends what you're invested in, but whatever. New mantra. I don't know. I don't care. Life insurance. We just talked about that a moment ago. New terms to increase payout on deals. Okay, good on the leveraged loans. Nothing really jumping off the page. Investment banking. Dubai, some more activity out of the Middle East, out of Europe, some good stuff out of India as well. Let's see, JP Morgan, Banker to Juniors, well-being. Oh God, I don't care about the well-being stuff. High pressure, long days, crushing workloads. Why is investment banking like this? Because you have to review thousands of deals before you find one good one. If you're not cut out for that, then frankly, don't do it. I mean, I don't know. I'm not like a pull yourself up by your bootstraps kind of guy, but it's not easy to find good deals. So yeah, the pressure, you have to find good deals. You can't find a good deal in a short day. So you have a crushing workload. Why is investment banking like that? Because it's hard to find good deals, and everyone's fighting for good deals. Because a couple good deals will make your career. You do like one or two great deals, that's it. You got it made, baby. You got it made. So yeah, if it were easy, I mean, what do you expect? Business deals. Yeah, just going through headline stuff. I'm interested to see how this unfolds between the U.S. Steel deal. I mean, that's just one of those things. Like as an American, our manufacturing base being sold to Japan. I have no problem with Japan in terms of our sovereign relationships, but come on. I was actually kind of, for once, that was one time where a buyout. I was glad when there was someone stepping in to say, all right, let's get this reviewed. Maybe we got to keep U.S. Steel in America. GameStop CEO, always interesting to figure out what's going on. Wells Fargo securities acquisition violation. I don't know. I kind of don't care about the GameStop stuff and the short squeeze, whatever. Roaring Kitty. TD Bank, veteran to succeed. Okay. Indian CEOs do well in tech and banking. I'm just going to throw that out there. This is interesting. Qualcomm approached Intel about a takeover. I don't know what's going to happen with Intel. I've had clients that keep reaching out to me, if I'm so bullish on the AI revolution. Not to say that I am, but why not get involved in Intel? I don't know, man. Those guys are losing monumental amounts of money in such a favored sector. Between the CHIPS Act and the Inflation Reduction Act, they had so much subsidy, and still they're down from like $80 at their high a couple years ago to $20 a share. I'm not exactly interested in buying a stock that's with a chart like that. But let's see. I don't know if there's buyouts or what's going to happen there. And then the Starboard proposal for News Corp stockholder vote on ending dual class structure. Yeah. Um, the inference when this type of stuff is getting done is that you gotta get all buttoned up, get your ducks in a row, get your affairs in order ahead of unleashing the treasure trove of cash into the deals. So good. Get these proposals done, get these new structures up and running, and let's put the capital to work. Okay? So I still think capital markets are going to become healthier and healthier, and that we're really going to kick things off beautifully in 2025, especially if deal culture comes back into the mix. And I know a guy who knows a thing or two about the art of the deal. Let's just leave it at that. And the last section here, looking at public markets, starting with our friend Heisenberg's chart, scenario A or scenario B. This this triple top, which there's really no such thing. We've broken above it. Scenario A, we got above, had this classic distribution pattern, and we came down 12%, bounced, and then came down again. That was back in 2022. Scenario B, similar pattern, breach above this triple top, and then able to sustain it, up 10%, pull back, and then we've ripped ever since. Is it a coin flip? I don't know. Let's look at more data points. From the great Wayne Whaley, this is when September, supposedly, well, not supposedly, the data says one of the weakest months seasonally. Quarter three volatility, risk off ahead of election, inflation, rates, recession, whatever it is. But here's the data. After a 12-month high in September, not just a 12-month high, but a new all-time high, what does the data say? 25 wins and 4 losses. 3% moves, 15 and 0. And to be clear, we're looking at how we do between October and December when we make a new high in September. The data seems to indicate, what is that, 25 out of 29, about 82, 83% chance of being higher, with an up down with an average return of around 4.25% higher. Looks all right to me. Now, the most recent cut in the past 10 cycles, a little bit all over the board, but let's see. We've been green 6 months later, 70% of the time, 12 or 80% of the time, average of 8% higher, median of 11.5% higher. So it's better than a 50-50 chance that we're going higher, isn't it? At least according to the data. And what is ultimately going to lead markets? Here you have an earnings bull market. Typically, going back to the dot-com crash, dot-com bubble, global financial crisis, COVID, just a little bit of a rolling over in 2022, 2023. But typically, after you have this plateauing and this rolling over, then enough is done to right the ship, and you get a new earnings bull market. And if corporations in the public and private sector are making more money, the share price is going to go up. So unless we get a dramatic repricing of our earnings estimates, or something happens, we stumble on an obstacle, got to think that we could go higher from here. And here's one that seems really counterintuitive. What happens if you invest on any day versus if you invest at all-time highs? This is the classic thing that people don't want to invest at all-time highs because they want to wait for the pullback. I don't want to get in here. It's too expensive. Valuations are stretched. Yeah, logically, that makes sense, right? In reality, if you invest at all-time highs, a year later, you're up. 3 years later, you're up. 5 years later, you're up. We're at all-time highs right now. I don't know. Not financial advice, but this is what the data says. I know it sounds counterintuitive, so I'm not making this as an argument. I'm just showing you this is the data. Speaking of stretched valuations, here we have the NTM price to earnings. We're looking at where they are currently. Energy only at 12.5, financials at 16, utilities at 18. Comm services 18.5, real estate at 19, healthcare at 19. You could make a case that those are not bad. I mean, everyone is so quick to point out the bubble. They'll find the names with like in the 50 or even in the hundreds with these price to earnings ratios that seem really high, but based on their earnings growth, maybe not so high. And I don't know. I mean, energy sector, utilities, with it's everything that's going to happen in terms of how much energy we're going to consume, how much needs to be produced. I don't think we're that expensive in those areas. And then you can also make a z-score with a median z-score where they are now compared to their 30-year averages. And if you're a little elevated, which you can probably find it in places like tech and some of this hyper growth area, sure, you're going to find some crazy scores there, but we're not really off the charts per se in places like real estate, energy, healthcare, utilities, financial. I don't know. I'm tempted to get in on this bearish narrative and all this stuff about we are in a bubble, late stage cycle. I know that across the board, we could come down 5, 10, 15, 20%. And if we did, that would probably be the sort of thing where the tide comes out. We figure out who's swimming naked, the yen carry trade unwind, and I'm sure all sorts of chaos could ensue. But if you just take a sober look, take a deep breath, look around all these different data points, we've if we've been in worse situations in terms of stretch valuations and bubbles. And the assets year to date, we looked at this one before because if you want to get creative, let's say, like in 2010, after a financial crisis, when gold was toward the top, and it was there in '08, and it was there in 2011 too, or toward the top, I should say, then is there a resemblance of like what we could see from 2020 when gold was a leader and then commodities were ripping, and then 2022 happened when S&P was crushed and fixed income bonds were killed? Is that is Are we getting like this tip of the cap, this little hint? Gold is trying to tell you something. I don't know. I mean, gold being about 4 percentage points higher than the S&P 500 is certainly noteworthy in terms of monetary stimulus, but really, let's think about that. So, money's being introduced to the system. There is financial system risk along with geopolitical risk, macroeconomic risk. You just keep building your position in gold and precious metals, maybe precious metals mining. Is it the zombie apocalypse stuff? Maybe it is, but I think really what's happening is gold continues to track liquidity, continues to be a decent hedge for the macroeconomic risks, the systemic risks, the politics, the war, the inflation. And since it's only garnered like 1% of asset managers' portfolios, it's just maybe time to increase it to 2% or for 3 or 5. And if it gets up to like 5 or 10%, it's still, compared to a 60/40 standard traditional allocation, gold is hardly anything. So it has a lot of room to grow. I think that was the realization that's triggered this rally. Obviously, there's still a bunch more room to the upside, but is it the doom and gloom scenario that the gold dealers are trying to paint you? Probably not. But that said, like I mentioned earlier in the video, we will talk about how we hedge sovereign risk and what steps you could be taking if you want to rebalance your portfolio, take some chips off the table, de-risk a little bit, lock in some profits, and get yourself set up for if there is chaos. Because in the same way I have insurance policies for myself and for my business, I don't expect to need them, but if I do, they'll be handy to have. So we are going to do a video about that. I'm going to try and get that done today or tomorrow because I've been getting a lot of questions about how to prepare, and I have some cool stuff to say on it. So keep the, what do they say, the bell icon on, notifications, stay subscribed, because that one's going to be coming out as soon as I can make it. And that's going to be really, really juicy, good stuff. It should be behind a paywall, frankly, but I'm just too excited to talk about it and share it with you guys. So thank you guys for watching. Stay tuned for our next one, and I hope you will stick around this channel. All right.